Drill, baby, drill. What's going on with the oil price and the energy industry and energy per se? So, this session, we will have a look at the oil to gold, oil to silver ratio. I like analyzing ratios with cycles. And let's see what that ratio and cycles tells us for oil and gold and silver. Let's see.
From the mind of Lars von Tienen, the most advanced cycle analysis, hot off the press.
Yeah, talking about oil energy. I mean, if you have looked up the previous episodes, you know that I'm deep into the GDP, the economic business cycle perspective, coming from different perspectives. So today, energy as headline, oil as special subject, using ratios, so not the raw oil price, but ratios for oil. That's it for today. So the main topic is, for starters, let's think about that. I mean, using ratios, especially in commodities. So gold to oil, oil to gold, so commodity to gold, commodity to silver. Those ratios give you a quite good indication if there are divergences in special commodities. So, for example, it's very common that metals and oil or gold and oil move more or less in tandem, either up or downwards. So what we see right now is a very rare and special situation that gold and silver really shoot up to the moon, while oil is still subdued and very low from a pricing level, which gives us a divergence just between those two commodities, which is quite rare and not often to be seen just from the raw values. And we can measure that by using the the ratio, which will then help us to identify the swings in that ratio. So when we maybe can expect gold or oil to move in the one or the other direction, if we can find then, from a timing perspective, interesting cycles, that could become interesting. And that's what I want to share with you today, right? So let's open the chart. First, let's open the chart on the ratio first. So let's explain what we are seeing. What we are seeing here on the screen while zooming in. So this is a ratio, as mentioned. So we see the oil price measured in gold. Yeah, so that's the key point here, what's on the chart. So not the oil price measured in US dollars. We divide oil versus divided by gold, both measured in US dollars, which gives us the oil to gold ratio, or oil measured in gold. That's the term here. So you often might also see the other way around, the gold to oil ratio. It doesn't matter which way around, so the message would be the same. So this is the raw information here, and now we can see where those peaks or where those points in time with high divergences have been in the past. So here, looking at this point in time, 2009, we had a peak in that ratio, which means at that point in time, gold was very low and oil was very high priced, and the other way around. Here in 2009, January 2009, we had a kind of low in that ratio, which means that gold is higher priced than oil, at least in that historical perspective. And look at where we are now. So we are at a very historical situation, almost not really the lowest. So this was the COVID situation, where the economy even slowed almost down to zero. So now here we have the situation, not due to the economy slowing down, but because gold is really moving up, and the oil price is more or less at a low level, yeah, which brings that ratio really down since the year of 2022. So, and the historical low level has not been seen for a long time. So that's just the raw observation. And now we will bring in cycles just in a moment. Before bringing in the cycles, let's maybe think about for a moment what happened at those points in time, when those extreme low ratios have been reached. So low ratio in oil to gold. So, and as we're talking about energy today, so let's look at the raw oil price at those points in time when that ratio hit an important or major change in trend with making those lows. So let's switch to a raw oil chart now, so which I've prepared here, and you might see I have already highlighted those points in time. So here has been the point in April 2020 when that series in April 2020 made a change in trend at that point in time, right? So that's exactly when we had a huge up move in oil afterwards. So then we can also have a look here at the point in February 2016. February 2016 is here, where we had the low in the ratio, and the absolute oil price made a low here and then had an up run just after. So let's go back in history here. Even January 2029, and the oil price made a low and then had 5 years of upswing afterwards. So here we have 2029, the low, 5 years of upswing afterwards. And even the major lows in this historical position here, January 2029, can be seen here, January 2029. So we had a clear turning point in the ratio in that series. And afterwards, 2029, I mean, we have even a decade of upswing, up move in the raw oil prices, right? So I hope you got the message. Those turning points in the oil to gold ratio have marked decade, long-term lows in the oil price for years to come afterwards. So that's what history tells us. That's what the ratio shows us. So if we are able to detect possible change in trend in the oil to gold ratio, this could mark the beginning of a long-term upswing for oil. Okay, so that's how reading the raw data. Now let's put cycles on top of that. So, I mean, it's always hard to time, to know when a change in trend has occurred. We only know this after the fact, right? So therefore, first we can see, is there a cyclic behavior in making bottoms in the oil to gold ratio? That would be the first question. Can we identify, can we isolate cyclic behavior in what we have seen? Question 1. Question 2, if we can isolate cyclic behavior and the previous changes in trend, and you have seen what this marked in terms of price, where would we be in that current cycle swing, and what the projection of that cycle into the future would tell us? I mean, that's the second question, and this is why we are here doing cycle analysis of that kind of data. So now let's activate our cycle scanner on that data set and see if we have a cyclic behavior in that rhythm. So back to the ratio, right? So I explained what we see here, and now we can have a look at the spectrum, yeah, what our cycle scanner is doing. I will start with the long-term perspective first, because I want to understand from an historic perspective, is there cyclic behavior? So therefore, I'm using the full series with over 2,000 data points going back into 1980. So I want to do a historical analysis of that cycles. So we see the spectrum here at the bottom. So there are 4 to 5 cycles which could be taken into account, but we now need to judge which cycles are looking good for trying to make a projection or to use that. So therefore our rating criteria come into play. You will see this in the upper right for sure. So the cycle with a length of 234 weeks has high strength, has the best ranking and the highest stability. So this qualifies right out of the gate for a very dominant stable cycle. Yeah. So let's look in the spectrum, and it's this one here in that spectrum. So also explaining the ranking. The ranking is based on the visual shape, on the prominence of that cycle here. So I mean the left shoulder is almost perfect, coming down here close to 0. The right shoulder is almost perfect, even symmetric here. And it's for that length, it's even a sharp peak here. And the amplitude, even the highest amplitude of all other peaks here. So that's the shape, that's the prominence. This is where the ranking score of 1 is based on. So the second important information, as you might be aware, but I want to repeat it so that everyone knows how to identify and isolate cycles, is the stability score. The stability scores tells us something different, which cannot be seen in the overall spectrum analysis per se. So the stability tells us over time how stable was that cycle. And by stable, I mean the variance of that cycle should be as low as possible. I mean, in the real world, we never see symmetric, static, sine wave cycles in real data sets. Yeah, so it's just the hypothetical, theoretical way how to see cycles with that static sine wave chart. So reality, real life rhymes and is not static, perfect. So therefore, the stability score gives us an indication about a 1 would be a perfect static sine wave, and a 0 would be that the length and the amplitude of that cycle would fluctuate so high that even though there might be a rhythm in that, it cannot be used for forecasting, because if the variation is so high in that cycle, you have no clue about what the variation will mean for the future of that cycle. So even though you can detect it, if the variation is too high, it's more or less useless for any projection. So that's why that second measure on stability is such important for the projection, not for the historical detection with spectrum analysis. So I think we have a clear message here. So we can identify the most dominant cycle. We have very, very objective parameters, which we always use here. So we overlay that cycle, and let's have a look at that cycle and how it looks like. Before judging where we are in that cycle, and that's what stability tells us, if we activate the stability view here at the bottom, yeah, you see how that cycle, the blue line and the red line, so the blue is the real cyclic behavior of the price data according to that length, and the red line is the theoretical cycle. And I mean, even if we zoom in into the past 20 years, you see here how that even just simplified zigzag fits into that place. And you can even scroll back into the years of 1990 and 2000 where you have the same behavior even going back to 1990. So that's the stability score, just explaining the mathematical terms in a visual representation and shape. And look where we are in that cycle. I mean, I don't know if you need my comment anymore. So that cycle speaks a clear message. So first, yes, there is a clear rhythm in that ratio. So we're not talking about random changes in trend from a time series perspective. So looking at the whole time going back to 1980, there is a dominant rhythm. Yes, it is. Can we use that rhythm for projection? Yes, we can, because there's a high prominence of that cycle and a high stability. So our two questions have been answered, which brings us to that overlay and that projection of that cycle. So, I mean, a ratio, as you're all aware of, can change by two impacts. So that's also to be said and to be clear what we're talking about here. So it is expected that this ratio will rise again. So that's the neutral message here. So the ratio can rise if the gold price would come down, or if oil price would rise, or both happens. So that's how to read ratios. So in terms of this cyclic behavior, so remember what I showed you at the beginning, that cyclic behavior related to those extreme lows, which have a rhythm, always have been in alignment with major long-term bottoms in oil, which then followed a multi-year upswing in oil prices. So that cycle can also map to oil prices. And if you look at the oil price with that cyclical timing indications, in the past it always marked this multi-decade afterwards uprise in oil. So I think it's worth mentioning where we are. I mean, we could do the same using silver, looking at the ratio of oil to silver. I mean, the picture would be the same. But before doing that, let's also discuss a little bit the other cycles here, right? I mean, we are here for cycle analysis. So there are some other cycles which could qualify. So, I mean, the longest cycle of 396 weeks, the stability score is still fine, the ranking is also fine, and the length of 140 stability and ranking is also fine. So we could also add a more complex cycle analysis picture here by choosing or trying to use those three different cycles here to create a projection, right? So let's do that. All right, so we started with this one here. So the longest cycle, which would be this one here, 396 weeks, a very long-term cycle. But let's activate it, and voila. You see where we are? I don't need to zoom in, right? So I can zoom out here. So that cycle is also clearly visible, maybe not that stable, as the other one, but maybe you got the point here. So it's also bottoming here at the end of 2026, right? Now I wanted to mark the bottoming window of that cycle here. All right, so that's the 396. Let's also jump to the 140 weeks. Let's mark the bottoming perspective here. And now let's get back to the 234 cycle and the bottoming window, which is here. So you got it? I mean, by the way, what I really like is here 234. I mean, that's a kind of number thing. 234. Maybe something for numerology. Okay, I don't know. So that's not the topic for today. What I want to highlight here is that all 3 cycles, it even would not matter which one to pick. All 3 cycles indicate the same window of time when those 3 cycles expect a change in trend in that ratio. That's also a rare occasion. That's what we call cycles within cycles from a cycle analyst perspective. So by analyzing these 3 cycles in isolation, we can now create next a composite cycle projection from that by activating all 3 cycles in parallel. But I mean, what would you expect if we add up 3 cycles which have a cycles within a cycles alignment at that current point in time? It would amplify the bottoming period, right? So try to imagine and understand what it means when we have those 3 cycles in isolation forming a bottom right now. It would be amplified in the composite. So let's have a look on that. So let's activate all 3 cycles, and you see how they amplify that major low here. So we can also zoom out a little bit. And let me finally zoom out into that window here. So what's even more important here, just have a look at the composite bottoms here, timing-wise. Here, right? So you remember at the beginning, I showed you what happened at the extreme bottoms. But here you can see that there is, I would not call it magic, but there is a rhythm, right? The rhythm of those 3 cycles synchronizes their lows exactly at those points in time after the oil price made a multi-decade up move. So, I mean, maybe we need to wait 10 years or 5 years to prove that analysis, but I think it's worth really not having a look at that raw data of the ratio. Also, if you really see the cyclic rhythm of not one cycle, there are 3 cycles which of different length. Yeah, so there are times they are out of phase, and there are points in time when their bottoming phases aligns. And again, I think I've repeated this now for the 5th or 6th time. When those cycles bottom align, we have always seen a major long-term upshift in the energy oil price. Serious. Right? So that's the message. That's what the data tells us. That's a rare situation. And I don't have more to tell. So sometimes it's that simple. Yeah, about that cycle analysis. I hope you liked that episode and the perspective on oil in combination with gold. So just to sum it up, ratios are a very nice way to analyze divergences between commodities. So keep in mind the gold to something, oil to gold, oil to silver are always important. You could use other ratios for sure. Then identifying cyclic behavior in those ratios might guide you in terms of timing. Yeah, when those extreme divergences between those 2 assets you are putting into a ratio might reverse. When that reverses, and that depends on some cyclic nature, you can use this for timing. This is what we have done here in the purpose of oil and gold. All right. Thanks for joining me today. I hope you have a nice week for the next week. And I'm looking forward for the next episode, right? See you soon. Bye.